When someone told me you can make a full-time income just from selling covered calls, at first I kind of laughed in my head, but then I tried it and it worked. And so I was hooked. And recently that topic came up in conversation with a friend of mine. So maybe think about this video for you. If covered calls are so great, why isn't everyone doing them? In this video, I'm first going to share with you the pros and cons of doing covered calls. I'm then going to talk you through a real life covered call I'm in right now so you can see how to set these up in your own account. But first, let's address the question, why isn't everyone doing covered calls? I had a really good friend of mine who had several millions of dollars in the stock market. They had their account with one of the big institutions. When I told them about covered calls and showed them the amount of money they can make every month by doing them, they went and approached their broker, and their broker's literal words were, "It's like finding money on the street." And that conversation was about 25 years ago. And to this day, they still have never sold their first covered call. So why haven't they done that? Why haven't they tapped into this income stream? Before I address the reasons why people don't do covered calls, let me see what your stance is on them. In the comment section below, let me know if you've ever done a covered call. Or if you do them, are they a regular part of your trading strategy? If you don't do covered calls, let me know what's stopping you from trading them. That'll help me understand you, my viewers, better. All right, let's get going. First, are covered calls too good to be true? One of the challenges that covered calls face is that there's a lot of doubt and skepticism when it comes to them, and that really stems from not understanding them. As a result, they're an underutilized strategy in my opinion. There are lots of ways you can trade covered calls no matter what your stance is of the market. But if you don't understand how to trade them properly, then you're probably not using them at all. Or if you are using them, you may be using them the wrong way. The first reason people don't trade covered calls or don't trade them properly is that they were never taught properly how to use them. And for most people, they were never taught about covered calls at all. I went to my 12, 13 years of regular school. I then went to a 4-year university. I even got a degree in finance. Yet during all that schooling, I never once was taught about covered calls or options at all. In all those years, I had one class that involved a little bit of stock trading, absolutely no option trading. So the first reason why people don't trade them is that they're not taught about them, and many times they're not ever exposed to them. So it's not that people are ignoring using them, it's that they never even heard of them. And the reason for that is because our education system, it has some challenges. And that's even on the university level. Even for business students, there are some challenges. You see, all throughout people's initial schooling and even throughout university years, many schools, they only teach about CDs and bank accounts and how to get a loan. Now, they're really good about talking to you about loans. In fact, when I got my finance degree in university, the only real class I remember about finance is about mortgages. Then once a person begins to get interested in things like the stock market, the financial media, they don't explain it properly. And many times, they don't explain it at all. And why is that? Well, the advertisers who advertise on their channels, they don't make money if you buy and sell options. They make money if you put your money with them. You see, they get advisor fees. So why do they have any interest in you doing your own investing? As a result, they present these strategies like covered calls as too complex or too dangerous so people don't look into them. Simply put, most advisors don't want you trading covered calls. What they want is your money. Now, I will agree, covered calls, they sound complex, but once you understand them, you realize how simple they are and how powerful of a tool they can be. My personal belief is that you, my viewers, you're really intelligent people. But for those of you who have never traded a covered call, it's not that you're ignorant because you're not ignorant, you've just never been taught about them. And I was in that spot one time. So let's teach you about them. I first want to make sure you understand what a covered call is. Covered call is simply a stock position where you own at least 100 shares of a stock and you sell someone the right to call that stock away from you at some price. That some price that can call that stock away from you is known as the strike price of the covered call. So you own 100 shares and you sell someone that right to call those 100 shares from you at some predetermined price within a certain number of days. And those certain number of days, that's known as the expiration day or the days to expiration. So a covered call is really pretty simple. Even when people know about covered calls, many of them still choose not to trade in them. And here's why. First, they think if they trade covered calls, they're going to miss out on stock price appreciation. They say, what if my stock takes off in price and I miss all that stock price appreciation? And I understand that thought. But many times those same people, they're overestimating the stock's potential. That thought process, it generates a fear of missing out on that stock's appreciation. And as a result, they miss out on the consistent income that covered calls can generate. Just keep in mind that when you sell a covered call, you're not totally eliminating your upside. You're only limiting it to the strike price of the covered call that you sold. And that strike price, it's up to you. You decide what strike price of covered call you sell. But one of the hardest things about doing covered calls, especially if you have a small account, is that you need to own at least 100 shares of the stock. Let's take, for example, a really popular stock right now, Nvidia. In order to do a covered call on Nvidia, as you see on my calculator, you need about $13,000. because remember, you gotta own at least 100 shares of that stock, and Nvidia is currently trading for around $131. So that's part of the problem, especially if you have a small account. So what can you do about that? How can you sell covered calls even in a small account? If you look over here on this side of the screen, I've now sorted the stocks that I'm willing to trade in by price. And I've sorted the list from lowest price to highest price. But notice all the stocks that are currently trading for under $30 that I'm willing to do a covered call in. There's actually quite a few as I scroll down here. We probably have at least 20 of them that are around that $30 area that I'd be willing to sell a covered call in. In fact, just to name a few of them, here are some of the ones I have a covered call or cash care put option in already. Currently, I have one in CAG. I had one in SCHD that just got called away from me. I've done a lot of trading in OTEX as well as EPD. I also have a position in Campbell Soup, ticker symbol CPB, and then Comcast, ticker symbol CMCSA. And I've done a lot of trades also in UGI. And I currently have several positions in SMCI. I think scrolled away from me. Here it is, right here. And also WTRG is another one I'm definitely willing to do a covered call in it. So for someone that has a small account, well, if you trade a lower price stock, you can still consider doing some covered calls. One nice thing about this covered call strategy, you have just barely enough to do one covered call contract. We can work to slowly build the number of contracts over time. So even though you may start with just one covered call contract, you can always work to add money to the account or grow it with the cash that this strategy generates. You see that premium reinvesting and you slowly adding money to that account, it'll help you do more and more covered call contracts, which will help your cash flow grow and help your account size grow. That compounding over time can really add up. It may not feel like it, say for example, if you only have a $5,000 account, but if you're able to grow that account at 2% a month, and you're adding say $100 a month, and you reinvest all that money, without meaning that in year one, you'll be able to generate around $1,268. That's not a guarantee or promise you'll make that, but it helps you see how over time, making smart trading decisions and using this simple strategy, as well as adding to your account, it can help your account size grow. And then that compounding, that extra $1,200 you made over the first year, well, it goes from $5,000 to $6,200. And you're growing that $6,200 to an even larger sum, which can snowball over time. Now at this point, you might be thinking, I don't know, Randy, covered calls, I've heard if you do them, it limits my upside. It limits how much I can benefit from a stock that appreciates in price. And I do understand that thinking, but keep in mind that just because a stock might go up in price, it doesn't mean it will go up in price. On average, the stock market generally returns around 7 to 10% a year. So although stocks and stock prices may go way up some years, they tend to retreat back down to more normal levels in the following years. Now let's get to the real secret of successfully trading in covered calls. Why do I say they're potentially so powerful? Well, here you see the cycle of profitable trades when it comes to covered calls. Let's think through this process. This process is all driven by patience and consistency. I know those aren't flashy words that some YouTubers use, but they're real words. They can generate real money. Let me give you an example. Let's shift this away from money. Let's shift this away from investing and switch over to something like working out, like exercising. Now, if you haven't exercised in a long time or maybe ever, and you decide to go to the gym, how long will it take you to see results? Well, just because you go in there and do one full body workout real hard one time, you probably won't see results. Now, you might feel some results because you'll be sore all over, but you won't see results. But now you keep going to the gym for 1 month, 3 months, 6 months, and then all of a sudden you begin to see some results. It's the same way with strategies like covered calls. You may not see or feel them immediately, but over time, they can have a huge impact on your account. And we see the same thinking in multiple areas of our life. Like say, for example, you wanted to lose a little weight, or you want to become more healthy in your eating. You see, eating one healthy meal, it really doesn't make a difference at all. But now eating healthy for a week, a month, 6 months, or a year, now that can begin to affect your body. You can feel better, you can think more clearly, it can even affect how happy you are. So although you don't see the effects immediately, over time, it can make a huge difference. It's the same way with strategies like covered calls. Although it may not feel like you're doing a whole lot, over time, the effects can be tremendous. And here you see the cycle of that. At first, it may feel like you're growing very slow, and maybe you are, but you're growing. So it may feel like things are boring, like things aren't working out. But remember that equation. Boring, if done right, it can be very profitable, especially if you reinvest your profits. Now, if you're having to live on them, that's fine. Just make sure you're reinvesting at least some of your profits. The result can be tremendous, as you see up here. Compound growth, if done over a long period of time, it can yield tremendous results. They can be life-changing results. Now I want to share with you my cover call strategy. I'm going to share with you all the details of how I go out setting up my cover calls. That way, if you've never done one before, after this discussion, you'll know how to do it. And if you're already doing them, this might give you some tips on how to set them up better. how to make them more profitable for you. So here's a strategy I've lived on for years. As you're going to see, it's really easy once you understand it. So it all starts over here with your stock selection. And for me personally, this doesn't start with what people are talking about on YouTube or on CNBC, although I do get some ideas on stocks to research through those avenues. They're not the ones I just go with. I do some fundamental analysis. I want to make sure these companies are profitable, that they'll be around for a long time. You see, I don't want my team getting rotated in and out if possible. I want to keep the same team and just insert the players of the stocks when appropriate. So for me, every stock I trade in, it starts out with, is the company fundamentally sound? In just a minute, I'm going to show you the life cycle of a company I've been trading covered calls in for many years. But the next step in this process is that once you have a list of companies that you believe are fundamentally sound, you then sell a cover call in them. But at what strike price? What's the price you'd be happy selling that stock at? It's kind of that simple. Now for some it may be way up here, for others it may be down here, but choose the strike price that you'd be happy to sell the stock at. Because remember, you are giving someone the right to call your stock away from you at that price. Now there are a lot of things you can do to prevent that from happening, but that is a possibility every time you sell a cover call. So you pick what strike price to sell at. The next step is your position sizing. I know if you have a small account, this can be very challenging. If I just started with an account that only say had $10,000 in it, I would only trade in ETFs. I wouldn't trade in individual stocks. Yes, the return is not as good, but that diversification will protect you in case something happens with one of your companies. Now I have a smaller account and a larger account. My smaller account has around $50,000 in it. And in that account, for any individual stock, I only want to have at risk at most 10% of the account. In my larger account, my rule is around 2 to 3% initially. And if I need to repair the position, I want to have at most at risk 5% in any one ticker symbol of my overall account portfolio, or the overall amount I have set aside for that account. So 2 to 3% initially, 5% in worst case scenario in my large account, and 10% at most in my smaller account. Now let's talk about this next part of the process here, how to successfully trade cover calls. The next one is very important. It can be your greatest ally. It can also be your greatest enemy. You want to avoid impulsive decisions. What do those impulsive decisions feel like? They feel like fear and greed. If you realize you're making a decision based on fear and greed, it's time to really step back and analyze, is this a wise decision? Now, why is that so important? Because the market, it can be wild. Here you see a very popular stock, Nvidia, that I've been trading a poor man's cover call in. And notice the ups and downs of this stock just over the past 3 months. It went up 21% and then went down 23%. It went up 16% and then went down 27%. It went up 30% and then went down 13%. More recently, it's been up about 40%. If you can't control your emotions, then cover calls and investing, it needs to be taken out of your hands because it's too much for you. But I'll tell you from personal experience, you can learn to control your emotions. Just try to focus on thinking non-emotionally. You want to think logically when it comes to investing, and the same is the case when it comes to investing in cover calls. Now, when it comes to risk management, I mentioned to you how I handle it. I only have 2 to 3% at risk in any one ticker symbol in my large account. And if I need to repair that position, at most 5%. In my smaller account, I bump that rule to 10%, or maybe just trade in ETFs. So you have to decide for yourself, how do I want to manage my risk? Another thinking when it comes to managing risk is you just want to be careful about using leverage or margin. I encourage traders, especially new traders, to not use any margin or leverage. It can totally wipe your account out if you don't know what you're doing. So please just be careful when it comes to risk management. And I have several videos on that. So please, if you're not familiar with it, you're trying to get your own game plan up when it comes to managing risk, just go to my video list and search for risk, and some nice videos will pop up that'll help you out. All right, then we get to the rocket taking off, and that's trade and execution. When you place these trades, they don't have to be watched every day. Really, once a week, or sometimes, in some situations, just once a month, when it's time to roll the position, is appropriate. But you do want to monitor or watch them, especially when it comes to the expiration day. All right, so there you have my whole process. Now let's look at a real trade. I know when I was learning option trades, this is the kind of stuff I love to watch. So I hope this real life scenario helps you out. So here we're looking at a stock that probably all of you have heard of, and that's Realty Income. The ticker symbol is O, as you see up here in the top left corner. Now let me make this screen a little bit bigger for you so you can see the chart a little bit better. So now we have a nice big screen you can hopefully see the stock on. So the Excel spreadsheet has all the trades I've done in Realty Income over the past almost 5 years. It starts with this date right in here. And we're looking at the weekly chart of Realty Income. Notice it's been trading in a range with a high of around 76 and a low down here around, 42? So a pretty big range there for a relatively stable stock. And currently we find ourselves almost right in the middle of that range. During almost this whole time, over the past 4.5 to 5 years, I've been trading options against Realty Income. And for a lot of that time, I was in covered call options. Here you see the spreadsheet of all the trades I've done on Realty Income over the past almost 5 years. Notice we started trading in it back up in here August 19th of 2020. So we have a lot of history here in these trades. Now at first we were only doing cash secure put options because that's typically how I like to enter my option trading positions. I typically sell those put options, and when they're assigned to me, I then turn them into cover calls. And with a company like Realty Income, when I do cover calls, it means I own the stock. Well, I'll just start collecting the dividend. As you see here in bold, I've collected a lot of dividends over the years in Realty Income because it's the monthly dividend paying stock. So I'm going to scroll down here to the very bottom so you can see my overall numbers over the past several years. We have to make the decision, was it worth doing cover calls in Realty Income? I want to draw your attention to the very bottom corner here. Notice that over the past several years, we've collected a net of over $10,900 in this one stock. And this is my large account, which means I've at most had at risk 5% of my portfolio in this one ticker symbol. And for much of that time, I only had 2 to 3% at risk. But during that time, if you consider the approximately 400 shares I've owned on average, we've pocketed over $27 per share in Realty Income. And keep in mind that during that time, Realty Income kind of had a wild ride. Here you see in 2022, it had a pretty sharp and fast decline in only a 2.5 month time frame of over 25%. And then had another 25+% decline in less than 3 months back in 2023. So it's not like this has been some perfect stock to trade options in. It's been kind of wild, especially for a typically stable stock. But in the end, you see that as a result of selling cover calls, collecting dividends in those cover call stocks that we own, as well as doing some cash secure put options, we've done really well in Realty Income. Before I share with you a few of the most important tips when it comes to doing cover calls, I first want to address a question that I know someone would ask me. Well, Randy, how do you handle a situation where the stock you're trading cover calls in has a big drop in price? And that's a really good question because it will happen. Well, there's several things you can do. The first is to adjust the cover call strike prices you're selling. You could continue to sell that same cover call strike price. You just may not get much for those cover calls if they're pretty far out of the money. But if you're comfortable with the risk and you understood it, and I have a lot of videos on this, but if you're comfortable with the idea, you can sell cover calls below the strike price that you bought the stock at. And the goal will be to roll those cover call strike prices back up when the stock began to show strength again. And for me, since I keep my initial position sizing to 2 to 3% of my overall portfolio, and my max size is 5%, that always leaves me around 2 to 3% to sell additional cash secure put options to help fund rolling those cover calls back up if the stock began to go in the money on those cover calls. So that's where you see the second point here is to sell put options to generate income by selling additional puts, but also help fund rolling those cover calls back up. If they went in the money, you couldn't do those rolls for a credit. And if you just really wanted some protection, you might consider looking into doing some collars. Consider using the cash you receive when you sell those cover calls to help you buy some put options. The way if the stock were to drop way down in price, you have this put option insurance that protects your account. And the fourth point here is to spend some time understanding how to adjust your option trading strategy. I have a whole video playlist here on YouTube dedicated to adjusting or repairing positions that go bad. So please familiarize yourself with some of the techniques you can use to fix option positions like cover calls when they go against you, because they will. And once you know how to fix them, it's not a big deal. Before I wrap this video up, I want to share with you a few tips I think are very important that you know before you trade cover calls, or if you're already trading them, they're very important tips to keep in mind. The first one is something that happens multiple times a year. Most stocks pay quarterly dividends. Realty Income, it pays its dividend monthly. But you want to keep an eye on the ex-dividend date if you're trading in dividend-paying stocks. The reason is there's a whole stock strategy designed to capture dividends. And so if you sold a cover call option, there's pretty much no extrinsic value left in it, it's about to go ex-dividend, the likelihood of that stock being caught away from you are pretty high. So at that point, you might consider rolling that cover call early. And a question I get asked a lot is, Randy, should I roll this cover call option? It's about to go in the money, or it is in the money. My answer is always the same. Look at the extrinsic value. Before you consider rolling a cover call option, look at how much extrinsic value is left in it. If there's not much extrinsic value left in it, then it possibly is the right time to roll it. But if you still have a ton of extrinsic value that'll be burned off or will go away by expiration, then you really want to think through, is this the right decision? One way I do that is by looking at the annualized return based on the cover call I'm already in versus what I will get when I roll that option. So just think through extrinsic value. If you don't know what that is, I have a beginner video that talks all about it. So please check it out. And the third point here is that if you absolutely do not want the stock called away from you, you don't want that cover call signed, you want to keep an eye on extrinsic value. When extrinsic value gets close to zero, it's probably time to roll that cover call option. Because if you don't, the stock is more likely to be called away from you. And that's especially the case when you get within a few days to a week or so of the option expiration date. And the final thought here is to really be careful around earnings. When companies announce earnings, they can shoot way up in price or way down in price. So typically for me, if I have stocks I absolutely do not want them to be caught away from me, I will be very careful selling covered calls around earnings. And many times I won't do a covered call at all until after earnings. I'll simply let the previous one expire, I'll close it out early, and I'll open a new one after earnings. If I could go back and tell myself 4 things when it comes to covered calls, this is what it would be. Don't only chase the home run. I'm okay having a small percentage of my portfolio set aside for those home run trades. Trade consistent income. When it comes to you getting paid a paycheck, or if you're self-employed, getting consistent money, you don't want that money to be sporadic. You're not looking for that home run, you're looking for consistent income. The same applies when it comes to stock and option trading. Consistency wins over the long term. And keep in mind that covered calls, they won't get you rich overnight. In fact, very few things do. But covered calls, they can get you rich over the long term. And they can produce a nice consistent income that you can live on or use to grow your portfolio. When it comes to covered calls, if you're patient and consistent, they just might be the easiest repeatable income strategy out there. And finally, remember this: slow money is still money. Covered calls generate consistent money. And that over the long term can tremendously change not only your account, but your future. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a Patreon down at the link in the description below. Recently, a YouTube viewer asked me, Randy, when is the right time to roll a covered call or poor man's covered call? I answered that question in the video at the link above and the description below entitled, How to Fix a Poor Man's Covered Call. Until next time, happy investing, and we'll see you again soon.